if the climate stays the way it is now. There also are maps projecting the 100-year floodplain for 2030, 2050, 2070, and so forth. Those maps look like in the future, those probabilities will be higher unless David Keith and others are highly successful and we wind up reversing warming. So in this example, we look at the probability of a big event being 1%. If it's only in 1 year, then you can think of an expected value of these different actions. And the obvious thing, that you probably can't read these numbers. These are all costs, and the cheapest thing to do, I'm messing up on the reverse. So the cheapest thing to do here is to do nothing in a single year, because probably the big event's not going to happen. The big $30 billion loss, only 1% chance that happens, we'll just keep going. However, if you think about a longer time horizon, you think about a 25-year time horizon, moving into the area where you are in the 50-year floodplain or 2% chance of the thing being inundated, now you have about a 40% chance that the big one is going to happen sometime during the decision period, and the expected value for Mayor Jimenez is much better, a lower cost at $17 billion to actually build this plant instead of waiting for the big one to happen. So what they actually did was to raise the rates for water and sewer users in Miami. They used that incremental cash flow to sell a bond, which allowed them to spend the money to do a major bit of resilience work so that this asset would be durable for the next 30 years. So I usually spend 2 days on this with my MBA students, so I apologize for moving that fast to this piece. So there are basically 5 choices for what to do with assets like this. You can reinforce, invest money to resist something bad happening. You can rebound, meaning it's going to come back quickly. We won't put anything important in the basement. As a flood comes, we'll clean it up, and then our building's okay. You can retreat, saying, I'm really tired of all these fires. I'm just going to go somewhere else. You can restrict, meaning why are people even allowed to build in this fire zone or in this flood zone at all? Or you can rebuild, which essentially is do nothing and hope that somebody else rides to the rescue with their checkbook. Okay, thank you. That's until the start of Q&A, right? For 10 minutes? Okay. Okay. So, third example is around wildfire in California, but it could be other places. So here's a picture of Santa Rosa, California in 2018. Santa Rosa is the largest city in California between San Francisco and Portland, Oregon. And you can see here where the wildfires happened right in the suburbs and burned up homes. It wasn't just out in the woods someplace. And I just finished a project with a real estate group, the Urban Land Institute, looking at wildfire prevention of all parties working together in Sonoma, California. And the idea here was that there are regional resilience things that can be done together. There's an idea for a distributed generation. So a lot of you look, of course, at energy, but much of the fire is triggered here by transmission lines. So the utility has long transmission lines and they spark and they're old. And if there was distributed generation with localized renewables, wind, even gas plants, there'd be less fire. Similarly, storage. So you have less fossil fuel, you can optimize the day-night, which I'm sure lots of people have talked about. And optimization so that, for example, you can work on traffic patterns, not have to build more roads, share the water, get more from the same infrastructure. And there's lots of land use and structures. It turns out that there's quite a few technological advancements in hardening a home. So a home doesn't burn. You wouldn't have thought so. But a lot of homes have ventilation under the roof that has a screen that keeps out squirrels. You need a finer screen that keeps out embers, but also has the ability to bring in fresh air. There's a lot of technology there, fire detection technologies in the home and in the neighborhood, and particularly fire path predictive analytics. Nobody knows where these fires are going to go, and when you're trying to fight fire and move people out, those kind of analytics, which are probably generated by the same kind of machine learning techniques that you heard about before, will be really important. We also talked in this project, here's another big spreadsheet, about federated finance, meaning put all the capital sources together so that everybody who has money, like the federal government, the local hospitals, the employers, the insurance companies, the farmers, the homeowners, should put all this money in one pool and spend it against one project roadmap based on probabilities of how likely are we to need this, what's the expected value of these interventions. This works a lot better if you have cashless payments and tracking, whether through the blockchain or something else, of what these payments are, rather than collecting cash from people and wondering where it's going to leak to, and the provenance isn't correct. And the sensors and analytics measure what was the real impact. Did we actually benefit from the money that we saved compared to what would have happened before? And finally, all the open data gives you real-time financial reporting. An interesting example of that is here, around where sensor data is becoming democratized, meaning the data from lots and lots of individual air quality sensors is being combined in the cloud by a number of entrepreneurs moving way ahead of any of the government agencies. So this came out in the Yale Environment Review November 3rd, 2021. Today's November 6th. So this piece is 3 days old, about the eyes on polluters, the growth of citizen monitoring. A technology company called Purple Air makes these outdoor air quality monitors, and they also have them all tied into the web so the data is out there. They're not aggregating it, other people are aggregating it, so that they're able to predict where the particulars are going to be, when you should stay indoors, when your kids can go to school, those kind of issues. Obviously, a big issue in Africa, in India, and China, where the outdoor air is often quite poor. So these monitors are relatively cheap, and the cutting edge is what do we do with all that data? It's a big pile of info. Let me give you one last example, and then we can move to questions. So how do investors think about incorporating climate risk? There are a lot of people working in the stock market and private equity and so forth thinking, how do I make these kind of bets? So one aspect is that climate change could change municipal bond portfolio. Nobody cares about municipal bonds. Someday, when you get ready to think about a retirement account, 30 or 40% will be in fixed income securities, which are like these things. If these things do poorly, that is not good. So if property values go down in Sonoma or in Miami, then the loan-to-value ratio goes down on these bonds, and their debt service coverage goes down, the rating goes down, it costs your town more to build, and to borrow, your town has to forego schools and police and all these other things, and it becomes kind of a downward cycle. Not good. There are giant bets on this. There are numerous proprietary modeling companies taking information about geology, hydrology, meteorology, the physics of buildings, and saying, we have our own model. And it's all private right now. So many people are saying, why do these insurance companies and these rating agencies have better information than I do? Here's an example of one company called Heitman publishing this with Urban Land Institute. Moody's is a big security rating firm all over the world. They compete with S&P and Fitch, and they purchased Moody's so that they can sell climate risk information on a proprietary basis to some of their clients, essentially making bets against you and me. I'm not sure you necessarily want to make those bets, but you want to think that that exists out there and that there's a possibility to have a long-short strategy around these concepts. So let me give you a couple takeaways, and then I'm happy to take questions. And I hope you didn't get too much pedagogical whiplash from the difference between the prior speaker and me. One is, it's critical to do the things that were talked about this morning around greenhouse gas reduction and particularly energy transition, and all the really cool, shiny technologies at MIT around batteries and storage. It's not enough. So what we'll also have to do is think as society, as individuals, as companies, as investors, as nations, what are we going to do? Because it's going to be flooding, wildfire, drought, migration. This tends to be distributed very unevenly, inequitably. So there are substantial activities to be done at all these levels, homeowner watershed, and you and your investors or people with you can play defense, like we're talking about in Glasgow, or offense. Where can I find opportunity in this issue? Innovative technologies, which you're interested in the room, financing schemes, which I'm interested in, and collaboration models, which I research, have defensible intellectual property. They have scale and accumulated learning, and they have substantial global upside. You can use these tools around the world with respect to dirt, concrete, cash flow. So you have these very different client bases, like one can afford an eye surgery thing that's done with recombinant DNA and gene editing, and elsewhere you have millions of people who are still needing to get power and water and not get disrupted by flood. So there are opportunities here to address that. The tools of probability mapping, modeling, understand when it makes sense to do this. You can't just sort of throw up a one-size-fits-all. Individual benefits are important, so you need to use them to think about the avoided cost of bad health, the avoided cost of bad schools, and things like that. And there needs to be a lot of money. Governments don't have enough dough to do this. Development finance institutions like the World Bank don't have enough dough to do this. but there is trillions of dollars in the global financial system that needs to be addressed towards these issues, so it can be attracted and deployed at the venture level or at the deal level. And let me stop there and see if there are questions.
Thank you so much. All right, we'll open the floor to Q&A. If anyone has a question, please raise your hand.
Thank you, Mr. Macomber. Right here.
I can't wait.
Yeah, right here.
Okay. Hey.
All right, awesome. So my question is, nowadays there have been a lot of ESG, clean tech, sustainability-focused funds doing all these investments. However, the returns haven't really proved the theory. And in your opinion, what do you think are the missing factors that is preventing all these funds to drive returns and attract more capital/talent? Thank you.
Thank you. It's a good question about ESG ratings. So there's environment, sustainability, governance, and there's a concept that investors are interested in seeing that all their investments and their companies pass these ratings. So I have sort of a two-part answer. One is that the ratings themselves, which are done by third parties who look at the performance of public companies, are very new. And they're very confusing, and there's not much correlation between one rating company and another. So it's kind of a lot of noise. And so I think there's going to be actually an ESG plus R component, meaning the environment, sustainability, governance, and resilience. So of the physical assets of this company, supply chain of the company, location of the facilities of the company, how much are they exposed to climate? Or are we thinking that, even though this apartment rental company has really great governance numbers, all their apartments are going to get flooded, and this other company with poorer governance numbers, all their apartments look like they're built for going forward. Similarly, on the sustainability front or the environment front, the idea that you can invest to build better transit or to think of distributed generation in California so that you don't have these fires overwhelms what any ESG rating concern might be. So I'm much more interested in what does the investment actually do to accomplish E and S in a real step change kind of way, and less interested in a lot of analysts who are sitting off somewhere trying to get people to invest their money in kind of a crude way.
Very cool. Is there another question? If there is none, then we have to, okay, there's one more. Yeah, this will be our last question for this session.
Okay.
In the front.
Thank you, Professor. So we know government actually is playing a very important role in this kind of infrastructure investment, especially in China. And we have seen like some of the PPP, the public-private partnerships, not as successful in the past. So from your point of view, what's the key factor for the success of PPP, and what's the future of PPP?
So PPP is public-private partnership, and there are a lot of abuses of public-private partnerships. Those of you who know the UK have seen a lot of problems with privatization following the Thatcher time. Fundamentally, a successful public-private partnership needs three things. It needs an actual revenue repayment source, it needs contracts, and it needs accountability. So multiple public-private partnerships happen without those elements. It's used, the word's used a lot by politicians who have no money or by vendors who are trying to sell something. So you got to watch out for politicians with no money and vendors who are trying to sell something. In between, like this Carlsbad situation, the Carlsbad had very clear revenue and source of repayment. It had very clear accountability for what the privatizer has to do, what the penalties are for not doing it, and they had a clear bid and award process. Some of the Andean nations like Brazil and I'm sorry, not Brazil, but Colombia, Peru, and Chile are very good at doing that. But so that's one piece of it. The second is that China is really good at using public money to build infrastructure. One of the reasons I'm so interested in this topic is I would like to see India and the US and Brazil and Mexico also figure that out with their different kind of much sloppier political systems. So I think it's something where China, there's a lot of debt right now in the infrastructure space, but basically China has a big advantage for being able to, being led by engineers who have a long runway to do things that they think are going to serve the nation. So the comment's very appropriate in a US-China, in a China kind of context.
Awesome, thank you so much. Due to time limitation, we'll have to wrap up this session. But thank you so much for coming in today. We really like your talk. Next, we'll transition to